Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, welcome. Today we are cracking open a true classic, Trading for a Living by Dr. Alexander Elder. We're going to focus on the introduction, which lays out the three absolute pillars of success: psychology, trading tactics, and of course, money management. So if you've ever wondered what it really takes to succeed, let's dive right in. Okay, listen to this. You can be free. You can live and work anywhere in the world. You can be independent from routine and not answer to anybody. I mean, wow. Those are the very first words of the book, and man, they just hit you, right? That's the dream. That's what pulls so many of us into this world. It's not just about the cash. It's about that deep, real sense of freedom. But as we're about to see, getting there is, well, it's a whole different story. So the book calls it The Last Frontier, a journey to freedom. And for the author, Dr. Alexander Elder, this wasn't some kind of metaphor. No, for him, getting to the financial markets was a literal life or death fight for his own independence. And you really have to understand his story to get where his whole trading philosophy comes from. And just look at this timeline. It is absolutely wild. So he grows up in the Soviet Union, totally desperate to escape the system. He figures out a way. He becomes a ship's doctor, which gets him out into the world. And then in 1974, off the coast of Africa, he makes his move. He literally jumps from a Soviet ship and makes a run for the U.S. Embassy. Think about that courage. He lands at JFK in New York with just $25 and summer clothes in the middle of a brutal winter. Can you even imagine? And then a couple of years later, he's on a road trip, reads a book called How to Buy Stocks, and everything changes. For Dr. Elder, trading wasn't just about making money. It was the ultimate destination on his quest for freedom. Next up, the battle within, the internal enemy. Because the crazy thing is, after everything he went through to achieve freedom, Dr. Elder discovered that the biggest obstacle to success in trading wasn't some government or a lack of money. Nope. It was something much, much closer. It was the battle inside his own head. And this, right here, is the first huge hurdle that every, and I mean every, trader has to confront. Which brings us to a really tough question that he puts right out there, and I think we all need to ask ourselves this. Do you really want to succeed? And I know it sounds like a silly question, right? Of course I do. But hold on. The answer is way more complicated than it seems. Because a lot of people say they want to be successful, but their actions tell a totally different story. It turns out they might be chasing something else entirely. And he tells this perfect story to explain it. He had a friend whose wife for 17 years said she wanted to lose weight. 17 years! But she just kept sabotaging herself. Why? Because, as he puts it, the short-term pleasure of eating is stronger for her than the delayed pleasure of weight loss. That immediate hit of gratification was just too strong. And, sound familiar? That is exactly what happens to so many traders. They say they want consistent profits, but what they're really chasing is that quick, exciting thrill of the gamble, even if it blows up their account. And this really gets to the core of that psychological trap, right? It's the fantasy versus the reality of trading. The fantasy? You're going to stare at the screen and just reach out and grab millions of dollars. But the reality for most beginners, it's an absolute emotional roller coaster. You're either squirming in pain from a loss or grinning like an idiot from a win, but you're never actually in control. You're just reacting, getting thrown around by fear and greed. It's chaos. So, okay, let's say you do the impossible. You actually conquer your own emotions. You're a rock. Well, guess what? You're still up against a huge external enemy. Because the market, it's not a level playing field. Not even close. It is structurally designed to make it really, really hard for you to win. Now, you've probably heard people say trading is a zero-sum game, right? For every dollar someone wins, someone else has to lose a dollar. Sounds fair. Well, Dr. Elder says that is just marketing nonsense. The truth is way worse. Trading is a minus-sum game. Think of it like a poker game where the casino takes a little bit of money out of every single pot. That's the house, your broker, the exchange, they're always taking their cut. This means the winners always win less than what the losers lose. And that is so important to understand because it means the odds are literally stacked against you before you even place a trade. So how exactly is the house taking its cut? Well, it's mainly through these two things: commissions and slippage. Commissions are pretty obvious, right? That's the fee you pay your broker every time you buy and every time you sell. It's like a tiny tax on every move you make. Then there's slippage. Oof, that's that sneaky difference between the price you thought you were getting and the price you actually get. It might seem small, but add these two things up over hundreds of trades, and they become a massive drag on your account. And here's the key mistake that almost everyone makes when they start out. They look at commissions all wrong. Your broker might say, hey, a $30 commission is nothing on a $10,000 contract. And you think, yeah, that makes sense. But that is the wrong way to look at it. You shouldn't compare the cost to the total value of the contract. You need to compare it to your margin, the actual money you had to put up to take the trade. And that brings us to this number, 5%. Let's use the book's example to see how this works. Say you're trading a corn contract and you have to put up $600 as margin. Your round-trip commission is $30. Now, $30 doesn't sound like a lot, but $30 is 5% of your $600 margin. That is insane. It means you have to make a 5% profit on your trade just to get back to zero. You're starting in a 5% hole before the market has even moved a single tick. That's a huge hurdle to overcome. All right, the 3 pillars of success, your path forward. So let's recap. We've got the internal enemy, our own self-sabotage, and the external enemy, a market that's literally designed to take our money. It sounds pretty bleak, right? Almost impossible. But here's the good news. Dr. Elder says there is a path to success. But it's not a secret indicator or a magic formula. It's a foundation built on 3 crucial pillars. And here they are. Pillar number 1 is psychology. You have got to master your own mind. You have to see the market for what it actually is, not what you hope it will be. No more emotional trading. Pillar number 2 is market analysis and having a solid trading system. This is the technical stuff, learning how to read the charts, how to understand what the crowd is doing, and finding smart places to get in and out. And finally, pillar number 3, money management. This is the one most people skip, and it's probably the most important. You have to play defense with your money. I love this analogy he uses. A good trader watches their capital as carefully as a professional scuba diver watches their air supply, because if you run out, it's game over. And the thing is, you need all 3. If even one of these pillars is weak, the whole thing comes crashing down. As we start to wrap this up, Dr. Elder leaves us with this really important piece of advice. You can make this knowledge your own only by questioning it. What he's saying is, don't just believe me, don't believe him, don't believe any guru you see on the internet. The only way any of this stuff actually sticks is if you go out there and test it for yourself. Question everything. Prove it to yourself in the real world. That's how you truly own it. And that really leads us to the final big question that this whole introduction is really all about. After everything we've talked about, the inner battles, the stacked odds, the 3 pillars, where is the real key to winning? Is it on your computer screen, or is it in the mirror? I think Dr. Elder makes the answer pretty clear. The secret isn't some magic indicator. The real work, the real journey to trading for a living, it begins and it ends right inside your own head. All right, let's get right into it. Today, we're going to talk about what really separates the winners from the losers in trading. And here's a hint. It has nothing to do with fancy charts or breaking news. It's all about the intense battle happening right inside your own head. So let's just start with a really stark fact, right? Brokerage records tell us that a staggering 9 out of 10 new traders fail. They're wiped out, usually within a year. So what's going on here? Is the market just this impossible puzzle? Or is there something else at play? Well, here's the thing. The reason for that massive failure rate, it's not that people aren't smart enough. It's not about their education. And it's definitely not about finding some secret formula. The game is won or lost, right between your ears. Trading is first and foremost a psychological challenge. Okay, so to really get a grip on this mental battle, we've got to start at the beginning. Why is trading so appealing in the first place? I mean, the market dangles this incredible promise of wealth, of freedom, of a challenge that's almost impossible to resist. Let's dive into that. And this really gets to the heart of it, doesn't it? This is the core fantasy of trading. For so many of us, money is just a symbol for freedom, right? The freedom to ditch the 9-to-5, to be your own boss, maybe work from a laptop on a beach somewhere. And hey, it also pulls in people who just love a good puzzle, a real intellectual challenge. It feels like this amazing arena for self-fulfillment. But here's the catch. That incredibly seductive allure, it's also a trap, a really dangerous one. It pulls beginners in and gets them to believe in a bunch of fantasies about the market. And these fantasies, they seem harmless at first, but trust me, they are the direct road to financial ruin. So let's break these myths down one by one. Okay, first on the list, the brain myth. This is a big one. It's the idea that you're losing money simply because you're not in on The Secret, you know? And this fantasy, Man, it fuels a massive industry of gurus and charlatans selling these $3,000 can't-miss systems. And you see it all the time. Traders who are just demoralized, they whip out their credit cards, desperate to buy the one piece of knowledge they think they're missing. They don't realize the problem isn't a lack of information at all. And this quote just hits the nail on the head. The market is literally littered with PhDs and geniuses who fail spectacularly. Why? Because being book smart does absolutely nothing to prepare you for the kind of psychological discipline you need here. In fact, a lot of hugely successful traders never even went to college. The edge isn't how smart you are, it's your mindset. Plain and simple. All right, let's talk about the next myth. And this one is a classic excuse. We've all heard it, maybe even said it. If only I had a bigger account. You know the story. A trader gets totally wiped out, and then, wouldn't you know it, the market turns right around and goes exactly where they said it would. And they think, see? I was right all along. I just needed more cash to ride out that dip. This becomes their comfort blanket, their go-to fantasy. But let's be real for a second. Here's the harsh truth. A loser with a small account just becomes a loser with a big account. The problem was never the size of the capital. It was, and always is, the lack of discipline. Without that solid mindset, a bigger account just means you get to make bigger mistakes faster. Your mind is the real asset here. That's what needs the development, not your bankroll. And that brings us to the third huge fantasy, the autopilot myth. Oh man, this one is seductive. It's the dream of finding that magic black box, right? That piece of software that's just going to print money for you while you're off doing whatever. It's crazy when you think about it. You have people who've spent years becoming experts in their own field, and then they'll turn around and drop thousands on some prepackaged system for trading, all driven by greed and, let's be honest, laziness. It's like they're medieval knights paying an alchemist to turn lead into gold. It just doesn't work that way. And this quote just perfectly wraps up our whole myth-busting session. That whole autopilot myth, it really comes from this kind of childish desire to just be taken care of. But the market, it is the exact opposite of that. It is a stone-cold, zero-sum battlefield where everyone on the other side is trying to take your money. It's nothing personal, but it is completely ruthless. So if success isn't about having secrets or a huge pile of cash or some magic system, then what on earth is it about? Well, the answer is that your real opponent isn't some faceless trader on the other side of the world. Nope. The real opponent is the person staring back at you in the mirror. Look, we all have our stuff, right? Mental baggage from our past, how we feel about authority, our fear of taking risks, maybe a need for a little too much excitement. When you drag all those unresolved issues into the market, you're not trading anymore. You're basically turning it into your own personal therapy session. And let me tell you, acting out your internal conflicts in the marketplace, that is a very, very expensive form of therapy. So let's really zero in on this distinction because it's absolutely crucial. Most losing traders, they're not acting like serious business owners, not at all. They're acting like neurotic gamblers. The gambler is in it for the thrill, for the action. Winning isn't just about the money, it's about that feeling of power, that rush, that high. But the professional, totally different story. They're calm, they're objective. They're not chasing a thrill, they are simply executing a solid, well-thought-out business plan. And this leads us to a really shocking but absolutely essential idea. The author of our source material, after years and years of study, became convinced of this. Most failures in trading aren't accidents. They're not happening because people are incompetent. They're happening because of an unconscious wish to fail. It sounds crazy, but many traders have this deep-seated self-destructive streak. And the market, well, the market gives you endless opportunities to play that out. So you might be wondering, if a trader is stuck in this vicious cycle of self-sabotage, how in the world do they break free? Well, the tough part is, it almost never happens voluntarily. It takes a crisis. It takes a moment of such unbearable pain that it forces them, finally, to face the truth. And that moment has a name: hitting rock bottom. And this right here, this is a really powerful analogy that can change everything for a trader. A loser's relationship with the market is almost identical to an alcoholic's relationship with booze. And once you really, truly grasp that parallel, the path to recovery suddenly becomes crystal clear. You see, at the absolute core of the problem is denial. An alcoholic doesn't say, "My wife left because of my drinking." They say, "Oh, my wife left because she's crazy." It's the same with a losing trader. They don't say, "I failed to follow my own plan." They say, "My broker screwed me," or "the market was manipulated." They'll blame anything and anyone to avoid facing that one painful truth. They have lost control. In this denial, it can go on for years. I mean, years. But eventually, the pain just gets to be too much. We're talking losing money you absolutely can't afford to lose. The shame, the humiliation, it becomes so intense that it just shatters that wall of denial. That is hitting rock bottom. And yeah, it feels absolutely horrible, but it's also the single most important thing that can ever happen in a trader's life. Why? Because it's the only thing that cracks open the door to real, lasting change. So what's the first step out of that deep, dark hole? Well, it's modeled directly on the first step of Alcoholics Anonymous, and it requires just radical, brutal honesty with yourself. You have to be able to say, I am a loser, and you have to admit, I am powerless over these huge, out-of-control losses. It's only when you admit that you can finally start building a defense system, not against the market, but against yourself. Okay, so once a trader takes that incredibly difficult first step, that's when the real work begins. That's when they can start to rebuild and consciously, deliberately develop a professional's mindset. Because winners, they aren't just getting lucky. They operate by a completely different set of rules and principles. And it really comes down to these three essential pillars. I want you to think of them like the three legs of a stool. Kick out any one of those legs, and the whole thing just topples over. Now, here's the mistake most losers make. They focus only on that second leg, the treating system. But look, sound psychology is pillar number one for a reason. It's the foundation. Without it, the other two are completely useless. And that third pillar, money management, is your practical, everyday safety net. A huge part of this is what's called the 2% rule. It's simple. You never, ever risk more than 2% of your total account on any single trade. If you follow this rule like it's your religion, it becomes almost impossible to completely blow up your account. It is your number one defense against your own emotional, impulsive self. And really, this is what it all boils down to. It's the ultimate lesson. A sailor can't control the ocean, right? But they can learn to control their ship. And the market, that's the ocean. It's vast, it's powerful, and it does not care about you. You can't get mad at it. You can't try to reason with it. The only thing you have any control over, the only thing, is yourself, your own actions, and your own behavior. So we're going to leave you with this question, because at the end of the day, trading well has almost nothing to do with mastering the market. It is, and it always will be, about that long, difficult, but ultimately incredible journey of mastering yourself. So the real question is, are you prepared to do that? Have you ever just stared at a stock chart, watching it zig and zag, and it feels like you're looking at pure, random chaos? The crazy swings, the sudden drops. It doesn't seem to make any sense. Well, what if I told you the key to understanding all of that isn't buried in some financial report, but it's actually in human psychology? Today, we're going to dig into this idea that the market isn't a collection of numbers at all. It's more like a living, breathing reflection of our own collective behavior. And, this isn't some new age idea. The concept of mass psychology is actually a classic, foundational part of trading theory. I mean, long before we had algorithms and high-frequency trading, the smartest people on Wall Street knew a fundamental truth. If you want to master the market, you first have to understand the mind of the crowd. All right, so here's how we're going to tackle this. We'll break it down into 6 key ideas. We're going to start with the classic characters of the market jungle. Then we'll ask, what is price really? After that, we'll look at the market for what it is, a crowd, and explore that primitive pull that makes us want to join it. And then finally, we'll talk about how to think for yourself and adopt the professional's mindset of managing risk, not trying to predict the future. Okay, first things first, we have to meet the cast of characters in this financial jungle. It's really no accident that the language of Wall Street is just filled with animal names. These aren't just silly nicknames, they are incredibly accurate descriptions of the behaviors that drive every single move in the market. So you've got 2 main forces constantly at war. On one side, you have the bulls. Think about how a bull fights. It strikes up with its horns. These are the buyers, the optimists, who are betting that prices are going to go up. And on the other side, you have the bears. A bear strikes down with its paws. These are the sellers, the pessimists, betting on a decline. Literally every tick up or down on a chart is just the result of the epic battle between these two. But the fight isn't just between the bulls and the bears. There are 2 other animals that always seem to get caught in the middle. First, you've got the hogs. These guys are driven by pure, unfiltered greed. They take on positions that are way too big for them, or they get into a winning trade and just refuse to get out, always hoping for just a little bit more. And then you have the sheep. These are the followers, They just passively and fearfully chase whatever the latest hot trend is, or they listen to some guru on the internet without having any plan of their own. And this leads us to one of the oldest and probably wisest sayings on Wall Street. Bulls make money, bears make money, but hogs get slaughtered. The lesson here is so important. You can win by betting things will go up, and you can win by betting things will go down. But if you let greed, the mindset of the hog, take over your decision-making, you are just setting yourself up for an absolute disaster. The whole point is to manage your greed before it starts managing you. So we've met the players. Now let's talk about the game's scoreboard, the price. That number flashing on the screen seems so real, so solid. But what if I told you that the way we normally think about it is, well, it's a total myth? Let's peel back the layers and see what price actually is. Seriously, if you could get a room full of traders together and ask them that simple question, you wouldn't get a simple answer. You'd get total chaos. Someone will say it's a company's real value. Someone else will say it's just what the last person paid. Another will say it's what the next person is willing to pay. The confusion around this basic concept is just massive, and it points to a really deep misunderstanding of how all this works. One of the most common and kind of cynical views you'll hear is this idea of the greater fool. The theory is that the price of something doesn't matter as long as you can find someone, a greater fool who's willing to pay even more for it than you did. This perspective turns the market into a giant game of hot potato, not a place where we discover an asset's true worth. Here's another really great way to picture this. Imagine a company's real fundamental value. Now picture its stock price. They're connected, but by a mile-long, super stretchy rubber band. The company itself might be moving along at a steady pace, but that stock price, that rubber band, can be stretched wildly higher or be pulled way, way lower, all because of market emotion and speculation. So what's the real answer? Here it is. Price isn't a hard number tied to some concrete value. It's a psychological event. It's that fleeting, blink-and-you'll-miss-it moment of agreement on value between the hope of the bulls and the fear of the bears. It's nothing more than a snapshot of the collective mood at one specific instant. And that idea naturally leads us to an even bigger truth. If price is just a momentary consensus of minds, then what is the market itself? It's not a place, it's not a computer system, it's people. It's a crowd, a massive, emotional, and very often irrational crowd. Amateurs might see the market as a place to grow their money, kind of like planting a garden. But professionals, they see it for what it truly is, a battlefield. It's a huge mass of people, all trying to outsmart each other to take each other's money. It is not a cooperative system. It's a global competition of psychology and strategy. And this isn't just some trader saying. Way back, over 100 years ago, a social psychologist named Gustave Le Bon figured this out. He wrote that when individuals form a crowd, they create a kind of collective mind. And this makes them feel, think, and act completely differently than they would if they were alone. They become more emotional, more impulsive, less rational. Does that sound familiar? He was perfectly describing the stock market. So, okay, we get it. The market is a primitive, emotional crowd. That's one thing. But now we have to understand the deep, ancient, evolutionary reasons that make us so desperate to join that crowd, especially when the pressure's on. It's a fair question, right? If we know, logically, that the crowd can turn into a stampeding herd that runs right off a cliff, why does it feel so safe to run right along with it? The answer, it turns out, is buried deep inside our DNA. Think about it. For thousands and thousands of years, our survival literally depended on being part of a group. A lone hunter? Easy lunch for a saber-toothed tiger. But a group? They could defend themselves. That instinct is hardwired into us. So when we face the fear and uncertainty of the market, our modern-day saber-toothed tiger, our ancient brain just screams at us, find safety in numbers, go with the herd. So how can you tell when that primitive brain is taking the wheel and you're getting sucked into the crowd? Well, just ask yourself if any of this sounds familiar. Are you glued to the screen watching every single tick of the price? Are your emotions on a roller coaster, elated with your wins, crushed by your losses? Are you starting to trust some random guru on social media more than your own research and your own plan? Do you find yourself impulsively adding more money to a losing trade, just hoping it'll turn around? All of these are warning signs that you're abandoning your plan and just joining the herd. Okay, so we've diagnosed the problem. Our ancient brain wants to join the dangerous market crowd. So the solution has to be a conscious effort to fight that urge. It means we have to forge our own path by creating a disciplined, independent plan before we ever put a single dollar on the line. Now, the process itself sounds simple, but actually doing it is the hard part. It all starts with creating a detailed plan before you even think about trading. Then you define rock-solid rules for exactly when you will get in and exactly when you will get out. No exceptions. Step 3, you have to write it all down. Make it real, make it physical. And finally, the hardest part of all, once you are in a trade, you have to follow that plan, and only that plan, no matter how much your gut is screaming at you to do something else. I love this analogy. Think about Odysseus from Greek mythology. He wanted to hear the beautiful, deadly song of the sirens, but he knew it would make him crash his ship. So what did he do? He had his crew tie him to the mast. He could hear all the tempting chaos, but he was physically unable to act on his impulses. Your trading plan, that's your mast. It protects you from the emotional siren song of the market, and maybe more importantly, from your own worst impulses. And all of this leads to the final and most important mental shift you have to make. This is the core difference between how an amateur sees the market and how a professional survives in it. It's about completely giving up the impossible task of prediction. The difference really comes down to the questions they ask. The amateur is always looking for a forecast. They ask what's going to happen next, and then they trade based on a gut feeling. The professional, on the other hand, manages information. They ask, who is in control of the market right now? Is it the bulls or the bears? They look at the evidence, analyze the probabilities, and then execute their predefined plan. They don't predict, they observe, they react, and they manage. We're going to end on this quote from almost 200 years ago because it's as true today as it ever was. The market is a place where collective madness can take hold in an instant. The path to survival and success is not about trying to be smarter than everyone else. It's about having the discipline to separate yourself from that crowd and to come back to your own senses, one rational decision at a time. The real question is, can you be that one?
All right, let's jump right in. Today, we're going to talk about classical chart analysis, but maybe not in the way you're used to thinking about it. Forget just lines and patterns for a second. We're going to look at these charts as a window, a direct look into the market's collective brain. This is where you can actually see raw human emotions like greed and fear, battling it out in real time. So, let's get into it.
I absolutely love this quote because it just nails it, right? A chart is not some crystal ball that's going to predict the future. It's more like a Rorschach test. You know, those ink blot tests? What you see in the chart often says way more about you and your own biases than it does about the market. So what we're going to do here is learn how to read the actual story the chart is telling us, that human drama, the fight between buyers and sellers, instead of just projecting our own hopes onto the screen.
Okay, so here's our game plan. First, we're going to dig into that whole Rorschach test idea. Then we'll zoom way into the anatomy of a single price bar. After that, we'll talk about the market's emotional memory. Super interesting stuff. We'll figure out how to tell a trend from a sideways stalemate, learn how to actually draw the lines that matter, and then we'll finish with the hardest part of all, what's known as the hard right edge of the chart.
All right, part 1, the trader's Rorschach test. Look, before we can even think about drawing a single line, we have to get our heads straight about what a chart really is. It is not just data. It's a psychological battlefield. Every single tick up or down is a footprint. It's a piece of evidence left behind by the emotions of the crowd.
So if the chart is the battlefield, how do we begin to understand it? Well, you have to start with the individual soldier. And that's exactly what a single price bar is. Each and every bar, whether it's a daily bar, an hourly one, or even a 1-minute bar, it tells a complete self-contained story of the fight between the bulls and the bears during that period.
Now, this is where it gets really fascinating, because every bar has 4 key pieces of data. First, you've got the open. Think of this as the morning's opinion poll, right? It's mostly amateurs putting in orders overnight based on yesterday's news. Then you have the high. That is the peak of bull power for the day. It's the absolute highest point they could manage to push the price. The low, of course, is the exact opposite, the MAC power of the bears. And finally, maybe the most important one, the close. The close is the final score of the game, and it's settled by the professionals who have been battling it out all day.
And this really sets up the daily conflict, this tug-of-war between the amateurs and the pros. The open is so often driven by raw, overnight emotion. What do the professionals often do? They fade it. They trade against that initial emotional burst. That's why the relationship between the open and the close is such a massive clue.
If the price closes higher than where it opened, that's a pretty strong signal that the pros ended up being more bullish than the amateurs. And you always want to know what the pros are thinking.
Okay, so we've looked at the individual soldier. Now let's zoom out and look at the whole battlefield. And just like any real battlefield, there are certain key locations, right? Hills, rivers, trenches, places that are strategically important. In the market, we call these support and resistance. They're like these invisible battle lines, and they're created by something really powerful, the market's collective emotional memory. Support is pretty easy to picture. Just think of it as a solid floor underneath the price. As prices are falling, they hit this level, and suddenly, a bunch of buyers jump in. Why? Because they remember this level. They remember it was a good place to buy before. And that sudden wave of buying is strong enough to stop the fall cold and, just like a tennis ball hitting the pavement, cause the price to bounce back up.
And you guessed it, resistance is the exact opposite. It's the ceiling. So as prices are rallying up, they hit this point where sellers just swarm in and overwhelm the buyers. Again, it's all about memory. Traders remember, hey, this is where the last rally died out, so they start taking profits or even betting on a fall. It effectively puts a cap on the uptrend and pushes the price back down.
Now check out this chart of the British pound. It's a perfect real-world example. You can literally see these horizontal zones where the price just stops and turns around over and over again. But here's the really cool part. See what happens when one of those support levels finally breaks? That old floor immediately becomes the new ceiling. It flips and becomes resistance. This role reversal is one of the most powerful concepts in chart analysis, and it happens all the time.
So why does this even happen? This is the most important part. These aren't magic lines on a screen. It's pure, raw human psychology. Think about it. If you bought something and it immediately dropped, what are you feeling? Pain. You're just praying it gets back to what you paid for it so you can sell and get out even. Well, when thousands of people do that at the same price, that creates resistance. On the flip side, if you missed a huge rally, you're feeling regret. You're kicking yourself, just hoping for a little dip so you can get in. When thousands of people feel that same regret, their buying creates support. It all comes down to two powerful emotions, pain and regret.
Okay, but not all of these levels are equal, right? Some are like brick walls, and some are more like a picket fence. So how can you tell the difference? Well, there are three things to look for. First is length. The longer a level has been in play, the stronger it is. A 2-year support level is a whole different beast than a 2-week one. Second is height. The wider or taller that congestion area is, the bigger the psychological barrier it represents. And third, you got to look at volume. If a ton of shares traded in that zone, it means there's a huge emotional commitment from everyone involved, and that makes the level way, way stronger.
So we get the individual soldiers, the price bars, and we get the terrain, support and resistance. Now we need to figure out the state of the war itself. Is one side clearly winning and advancing in a campaign, or is it a total stalemate like trench warfare where nobody's gaining any ground? This right here is the core difference between a trend and a trading range.
And it's pretty easy to spot the difference once you know what to look for. A trend has purposeful movement. An uptrend is just a series of higher highs and higher lows. A downtrend is a series of lower lows and lower highs. Simple. A trading range, though, that's just aimless milling about. The price just bounces between that familiar floor and ceiling, going nowhere fast. It's all noise, no signal.
I love this analogy. A trend is like one army is clearly routing the other one. There's no question who's winning. But a trading range? That's like two evenly matched gangs fighting over one little piece of turf. They push and pull back and forth, but nobody can get the upper hand. And here's the kicker. Markets actually spend most of their time in this state of messy, sideways fighting. And this is so important. You have to use completely different tactics for these two different battles. In a trend, your job is to follow strength. You buy into uptrends, you sell short in downtrends, you just ride the momentum. But in a trading range, you do the complete opposite. You fade the extremes, meaning you buy weakness when it hits support, and you sell strength when it hits resistance. You have to be super nimble and ready to get out quick because there's no momentum to carry you.
Okay, so how do we actually see who's winning this fight on the chart? Well, the most classic tool in the toolbox is the trend line. It's super simple, but honestly, it's one of the most effective ways to just visually track the flow of the battle and see if the bulls or the bears are in charge at any given moment. Now, here's a pro tip that a lot of people get wrong. The temptation is to just connect the absolute tippy tops or the very bottoms of the price action. A much better trend line connects the edges of the main messy congestion areas. Why? Because those extreme price spikes, what some people call tails, that's just panic. That's not the real consensus. The true opinion of the crowd is in that main body of trading. And our job is to read the crowd, not the panicky outliers.
And just like with support and resistance, you have to grade your trend lines. They are not all created equal. You need to ask yourself a few questions. What's the time frame? A weekly line is a much bigger deal than a daily one. How long has it been going? The longer, the more important. How many times has the price touched and respected it? More touches equals more reliable. What about the angle? A really steep angle shows a ton of emotion, but it might not last. And finally, check the volume. You want to see volume confirming the trend, especially when price pulls back to that trend line.
And this brings us to the final and honestly the hardest part of all of this. It's called the hard right edge. See, it's easy to be a genius looking at a chart from 6 months ago, right? Everything looks so obvious in hindsight. But you don't get to trade in the past. You have to make your decisions right now, today, at the very edge of the screen where nobody knows what's going to happen next. You're in the fog of war.
You know, the left side of the chart is history. It's fixed, it's clear. But the right side, that's the future, and it's totally uncertain. Out there, on that hard right edge, indicators are going to conflict, patterns will look ambiguous, there are zero guarantees. So the goal of a good analyst isn't to find certainty, because that's a fool's errand. The real goal is to weigh all the evidence, think in terms of probabilities, and make a disciplined decision in the face of that uncertainty.
And just to make it even more challenging, you've got this classic problem: conflicting time frames. You might pull up a weekly chart and it's in this beautiful textbook uptrend. It's screaming, buy. But then you zoom into the daily chart and it's in a nasty downtrend, yelling sell. So what do? Which trend do you follow? This is one of the thorniest dilemmas a trader has to grapple with every single day.
And that takes us all the way back to where we started, with that Rorschach test. After going through all of this, the psychology, the battle lines, the deep uncertainty of it all, you have to ask yourself a really fundamental question. What is chart analysis really? Is it a hard science with rigid rules? Is it more of a subjective art based on feel and experience? Or is the chart ultimately just a mirror reflecting our own internal battle between discipline and impulse? I think that's a question every analyst has to answer for themselves.
All right, let's dive right in. Today, we're prying open the modern trader's toolbox and taking a hard look at computerized technical analysis. You know, in a world where markets are moving at the speed of light, the tools you use, well, they aren't just an advantage anymore. They're an absolute necessity. I love this quote from our source material because it just hits the nail on the head. It perfectly captures the massive shift in trading. Sure, a bicycle is a great way to get around. You can see the scenery, but if you're trying to compete in a race, you need an engine. In the trading world, your computer, that's your engine. It's the essential tool that gives you speed and efficiency. Let's really flesh out that metaphor. Think of manual charting by hand as like going for a long hike. You definitely develop an amazing intuitive feel for the terrain of the market, but man, is it slow. Computerized trading, on the other hand, is like getting into a high-performance car. You can cover so much more ground, way more markets in much greater depth, and you get to the point fast. And maybe the biggest difference? It introduces cold, hard objectivity. You and I can argue all day about a pattern on a chart, but we can't argue with the math when an indicator is pointing up or down. Okay, so where do we even begin? Well, the very first step, the most critical decision you'll make, even more important than the computer itself, is choosing your software. This choice dictates absolutely everything that follows, because your software is your toolkit. Generally, this software falls into 3 big categories. First, you've got the toolbox. This gives you a set of professional-grade tools, but here's the catch. You have to learn how to use them. Then, at the complete opposite end, you have the black box, which just spits out buy and sell signals with no explanation. Our source material puts it pretty bluntly. These are for people who believe in Santa Claus. Somewhere in the middle, you have gray boxes. But look, for any trader who's serious about building a real sustainable skill, the toolbox is the only way to go. So what should be inside a really good toolbox? Well, of course you need the basics, right? Daily and weekly charts, all the popular indicators you've heard of. But the really crucial stuff here is all about control and customization. A professional package lets you fine-tune every single parameter, write your own custom indicators from scratch, and, this is huge, backtest your strategies to see if they're actually profitable. The whole point is to empower you to become the analyst, not just some mindless follower of signals. Okay, with our toolbox picked out, let's pull out our very first and most fundamental tool, the moving average. This right here is the absolute bedrock of all trend-following analysis. This is just a brilliant analogy. Think about it for a second. A single day's closing price is just one snapshot in time. It doesn't tell you much about the overall mood of the market. But a moving average, it blends prices over a period, creating this composite photograph that smooths out all the daily noise and reveals the real underlying trend, whether the collective mood is shifting more bullish or more bearish. Now, moving averages come in two main flavors. You've got the simple moving average, or SMA. It's super straightforward. It just gives equal weight to every single price point in its period. Then you have the exponential moving average, the EMA. It's a little more sophisticated because it gives more weight to the most recent prices, which means it responds to changes faster. But the real reason we're talking about this is that the SMA has what our source calls a fatal flaw, a flaw that the EMA was specifically designed to fix. And here is that flaw, explained perfectly. A simple moving average changes not only when a new price comes in, but also when an old price drops off. So imagine a huge price spike happened 10 days ago. Today, when that old spike drops out of the calculation, the average is suddenly going to dive, giving you a false sell signal that has absolutely nothing to do with what the market is doing today. It's a totally unreliable guard dog. The EMA, on the other hand, only barks when someone is actually at the door. So, how do we actually use this? Let's take a look at this chart of gold here. The rule is just beautifully simple. Your only job is to trade in the direction of the EMA's slope. That's it. When the EMA is rising, you're in a bull market. Your mindset should be buy the dip. You're only looking for chances to buy, ideally on pullbacks toward that average. The second that slope turns down, your bias has to flip 180 degrees. Now you're in a bear market, and you're only looking to sell short on rallies. All right, let's grab our next tool and see how these ideas start to layer on top of each other. Moving averages are fantastic for telling us the trend's direction. But what about its strength, its momentum? Is it running out of steam? For that, we turn to one of the most popular indicators ever created, the Moving Average Convergence Divergence, or MACD. Now, the classic MACD has two lines that cross over, but we're going to focus on a really powerful evolution of it, the MACD histogram. See, this indicator doesn't just show you who's in control, bulls or bears. It shows you if their grip is getting stronger or weaker. It literally measures the distance between the two MACD lines, and the slope of that histogram is everything. A rising slope tells you the bulls are getting stronger. A falling slope tells you the bears are starting to take over. Just watching the slope of that MACD histogram is a really valuable signal all by itself. But it can also produce what our source material calls the single strongest, most reliable signal in all of technical analysis, and that signal is called divergence. A bearish divergence is a massive red flag at a market top. It's what happens when prices are pushing to a brand new peak. Everybody's getting excited, right? But the MACD histogram down below fails to confirm it. It actually makes a lower peak. This is a classic sign of internal weakness. It's telling you that the momentum, the fuel driving that price higher, is fading fast. And this chart just illustrates the concept perfectly. Take a look at this copper chart. You see the price rally from point D to make a new higher high at point E. To most traders, that looks like a breakout. But look down at the MACD histogram. The peak at E is way lower than the peak at D. That, right there, is a classic bearish divergence, and it's screaming that a major reversal and a selling opportunity might be just around the corner. And of course, the exact opposite is true at market bottoms. A bullish divergence happens when prices plunge to a scary new low, but the MACD histogram traces a higher, more shallow low. What this tells you is that the bears are just plain exhausted. The downward price move is happening on inertia, and meanwhile, the bulls are quietly gathering their strength under the surface. Let's go back to that same copper chart. Look how prices just collapse from point F down to a new low at G. Fear is probably off the charts at this point. But the MACD histogram, it refuses to make a new low. It traces a higher bottom at G. This bullish divergence is such a powerful sign that the downtrend is running out of gas, and a major buying opportunity could be setting up. So far, we've got tools that help us figure out a trend's direction and its momentum. But our next tool, the directional system, it answers an even more basic question. Is there even a trend here worth trading in the first place? The full directional system can get a little complex, but its single best signal is actually elegantly simple. It's designed to catch brand new trends right as they're being born. It all focuses on a line called the ADX, which measures trend strength. So, step 1, you wait for a lull. That's when the ADX line drops to a really low level, telling you the market is quiet, sleepy, trendless. Step 2, you watch for the spark. The ADX line stops falling and just starts to turn up. That's the first clue that energy is coming back. Step 3, you confirm the breakout. You need to see the ADX rise by at least 4 points, like from 9 up to 13. That move confirms a new baby bull or baby bear is being born. And finally, step 4, you trade in the direction of that powerful new trend. Okay, let's completely shift gears now and look at a totally different class of indicators. Trend-following tools are great when the market is making a big move, but what about when it's just chopping around, going nowhere? That is where oscillators shine. Their job is not to follow the trend, it's to catch the turning points. This is the absolute best way to understand oscillators. Just picture a man walking his dog. The man's path, that's the primary trend. But the dog, he's swinging from one side of the path to the other, right? That's the oscillator, measuring these short-term swings between greed and fear. Now, when the dog gets to the absolute end of his leash, what we call overbought or oversold, it's extremely likely he's about to turn back toward the man. So here's the really crucial takeaway. You have two families of indicators that are built for opposite conditions. Trend-following indicators, like moving averages, are what we call lagging. They confirm a trend that's already in motion, and they work best in trending markets. Oscillators are leading. They try to anticipate a turn, and they work best in flat, ranging markets. And this fundamental conflict is exactly why they will often give you completely contradictory signals. And that right there brings us to the ultimate challenge for any technical trader. You've now filled your toolbox with all these powerful, specialized tools. But a moving average might be screaming buy at the exact same time an oscillator is screaming sell, because they're designed for different jobs. So the final and most important question is this: how do you build a system that makes these contradictory tools work together in harmony? Because mastering that, well, that's what separates the amateur from the pro.
All right, today we're diving into one of the most powerful, yet, and I mean this, frequently overlooked tools in trading. It's not some crazy complex algorithm or a secret strategy. It's volume. It's the very heartbeat of the market. So let's get into it.
I want to kick this off by asking you a question. When you look at a chart, are you only ever looking at the price? Because if you are, you might be reading just half the story the market is desperately trying to tell you. See, price tells you what is happening, but volume tells you how it's happening and with what degree of conviction.
So here's the game plan for this explainer. We're going to build the complete picture from the ground up. First, we'll tackle the neglected essential itself, volume. Then we'll get into the really fascinating stuff, the psychology behind it all. From there, we'll lay out 4 key trading rules you can literally start using today. And finally, we'll break down 2 killer volume-based indicators, on-balance volume and accumulation/distribution.
So let's start with the absolute basics. What in the world is volume, and why do so many traders just push it to the side?
At its very core, volume is super simple. It's just the number of shares or contracts that change hands over a certain amount of time. And remember, every single trade has 2 sides, a buyer and a seller. Volume just counts up all those transactions, giving us this raw, unfiltered measure of the market's activity and just how many people are participating.
And what's so fascinating here is the huge difference in mindset. The amateur trader thinks, hey, you get paid on price, not on volume, and they just move on. But the professional, they understand that price is just the effect, volume is the cause. They dig deeper because they know that analyzing the force behind the move is the real key to understanding the market's true health and conviction.
So how is volume actually measured? Well, there are a few ways to do it. The gold standard, the one used by major exchanges like the NYSE, is counting the actual number of shares traded. It's the most objective, pure measure you can get. A less precise way is to count the number of trades. Now, this can be misleading, right? A trade for 100 shares counts the exact same as a trade for 10,000 shares. And finally, you've got tick volume, which just counts how many times the price changes. For our purposes, we're focusing on that first, most accurate method, the total number of shares changing hands.
Okay, so let's move to our next section and see how this all connects. Because volume isn't just a number, it's a direct window into the collective emotions of the market. It lets us listen in on the psychology of the crowd.
Think about it. Every single trade starts with a financial commitment, but it almost instantly creates an emotional one. Buyers want to be right, sellers want to be right. So when prices move, one side is winning, feeling great, while the other side is losing and feeling pain. The higher the volume, the greater the emotional intensity, and the more financial pain is being felt across the market.
This quote from the source material is, well, pretty stark, but it's a powerful truth about how markets work. A trend is like a fire. It needs fuel to keep burning. And that fuel? It's a constant supply of new participants, specifically new losers who are willing to take the other side of the trade. When you see steady, high volume in a trend, you're literally seeing that fresh supply in action, confirming the trend is healthy and has the energy to keep going.
This frog analogy perfectly captures how volume can reveal different kinds of market pain. A sharp price crash on a massive volume spike? That's like throwing the frog into boiling water. It's sudden, shocking panic, and people are forced out of their positions immediately. But a slow, grinding downtrend with moderate or declining volume? That's like slowly heating the water. The pain builds so gradually that traders become numb to it, often until it's way too late. As a trader, you can read these signals. Huge volume spikes often signal a climax, while slowly fading volume can signal that everyone is just getting exhausted.
So we can actually distill all this psychology down into 4 key signals. First, when price and volume are rising together, that's a big thumbs up. It confirms the trend is strong. Second, if the price keeps climbing but volume starts to fade away, that's a huge warning sign that the trend is running out of gas. Third, you want to watch for a massive spike in volume after a long move. This could be a blow-off top where the last buyers rush in before a collapse, or a capitulation bottom where panicked sellers finally give up, marking the end of the downtrend. And finally, if a stock breaks out of a range on really low volume, you should be super skeptical. It's often a false move, a head fake that's just going to reverse on you.
Okay, so we've covered the what and the why. Now let's get even more practical and look at 4 specific trading rules that can help turn all this theory into a concrete strategy.
Let's break these 4 rules down. Rule 1. Confirmation. If the price hits a new high and volume also hits a new high, that means the crowd is enthusiastically supporting the move. The trend is healthy. Rule 2. The retest. Okay, say you see a panic selling climax on huge volume. What you do next is watch for the price to come back and retest that low. If it does that on much lower volume, that's a powerful signal that the sellers are just psychologically spent. Rule 3. The divergence. If the price is making higher highs, but the volume on each new high is lower than the last one, that means the crowd's energy is fading. The trend is getting weak and is ripe for a reversal. And Rule 4. The pullback. In a strong uptrend, watch those little dips. If volume completely dries up as the price pulls back, it means the sellers have zero conviction, and the main trend is probably about to kick back in.
Now, while just watching raw volume is powerful, we can refine our analysis with indicators. Let's start with a true classic, on-balance volume, or OBV.
The idea behind OBV is actually simple, but it's really elegant. It just keeps a running tally of volume. If the price closes higher for the day, you add that day's entire volume to the OBV line. If the price closes lower, you subtract the volume. Think of it like a cumulative score of buying versus selling pressure over time.
This is the famous quote from OBV's creator, Joseph Granville, and it's the perfect metaphor. Price is the train, right? But volume is the steam. It's the power that actually drives it. OBV is designed to measure that steam pressure, and it often reveals what the smart money is doing before the train itself really starts to speed up or slow down. The real key is to look for when the steam and the train are out of sync.
And that brings us to the single most important signal you can get from OBV, divergence. This is when the price and the volume start telling 2 completely different stories. For example, imagine a stock's price is grinding its way to a new high, but the OBV line is just flat, or even worse, falling. That is a massive red flag. It tells you that even though the price is high, there's no real volume, no conviction behind the move. It's a classic sign that the trend is on its last legs.
Let's look at a classic example right here on this chart of Apple. First, look at the price in the top panel. In early April, it pushes up and makes a new high. Got it? Now, follow that same point in time down to the OBV indicator in the bottom panel. Do you see it? While the price made a new high, OBV made a lower high. That's a textbook bearish divergence. The train is chugging higher, but the steam is running out. And then notice how OBV breaks its own trend line right at point B. That was the final confirmation, a crystal clear signal to go short just before the price completely fell apart.
Okay, Let's move to our second indicator, which gives us a slightly different but equally powerful psychological insight. This is the accumulation/distribution line, or AD for short.
The accumulation/distribution line basically asks one simple question. Who won the battle for control today? It doesn't care about where the price closed yesterday. It only looks at where the price closed within today's high to low range. So if a stock closes near its high for the day, that's a sign of buying pressure, or accumulation. If it closes near its low, that's selling pressure, or distribution. The A/D line then multiplies this by the day's volume to measure the strength of that buying or selling.
The psychology behind the AD line is what makes it so cool. The theory goes that amateurs often react emotionally to overnight news, and they drive the action at the market open. But professionals, the smart money, they tend to be more methodical, and they usually dominate the market by the close. Because the AD line puts so much weight on that closing price, it's designed to filter out the amateur noise from the open and show you what the pros are really doing. Are they accumulating or are they distributing? And you probably guessed it. Just like with OBV, the most potent signal from the AD line is divergence. If prices are falling to new lows, but the AD line is refusing to follow along, it suggests the professionals are quietly buying into that weakness. On the flip side, if prices are rallying to new highs, but the AD line is lagging behind, it suggests the pros are selling into the rally, distributing their shares to the unsuspecting public.
Let's see this in action on another Apple chart. Look at the bottom, back in October. Price makes a clear new low, right? But now look down at the AD line for that same period. It makes a higher low. That's a bullish divergence. It's telling us that while amateurs were panic selling to new lows, the professionals were quietly accumulating shares. Now let's fast forward 4 months to the peak. Price rallies to a new high, but the AD line makes a lower peak. That's a textbook bearish divergence, showing the pros are unloading their shares into the rally, a clear signal that it's time to sell.
We've covered a lot today, from the simple definition of volume all the way to the deep psychology it represents, and the powerful indicators that help us make sense of it all. You now have the tools to look beyond just the price and truly listen to what the crowd is saying. So the final question is, what will the market tell you?
All right, let's play detective today. We're going to dive deep into the stock market's psyche. Forget the blaring news headlines for a second. We're on the hunt for the market's secret mood, using a couple of hidden clues that can actually signal major moves before they hit the mainstream. So grab your magnifying glass. Let's start the investigation.
I mean, seriously, what if you could spot the cracks forming in a bull market way ahead of time? Or, on the flip side, see those first little green shoots of a recovery before anyone else? It kind of sounds like a superpower, doesn't it? But really, it's just about knowing where to look for the clues. And trust me, those clues are often hiding in plain sight.
You know, price charts are great. They're a perfect record of the past, showing us exactly what happened. But relying only on price is a lot like driving your car while looking only in the rearview mirror. It tells you where you've been, but not where you're going. To really understand where the market might be heading next, we have to pop the hood and check its internal health. And that's exactly where our detective work begins.
Okay, our first tool in the detective kit is all about leadership. We're going to track the officers of the market. Why? Because we want to see if they're actually leading the charge or if they're quietly sneaking away from the front lines.
So here it is, the new high new low index, or NHNL for short. Now it sounds a little technical, but it's a leading indicator that does something incredibly simple. It just counts how many stocks are hitting their absolute strongest point in a full year and compares that to how many are at their absolute weakest. It's a direct, no-nonsense measure of market leadership. And the math behind it? It's literally as easy as it gets. You just take the number of stocks making new 52-week highs, and you subtract the number making new 52-week lows. That's it. If you get a positive number, the bullish leaders are in charge. If it's negative, the bearish leaders are taking over. Simple as that.
Now, this right here is the key metaphor to really get this. I want you to think of the whole stock market, thousands of stocks on an exchange, as one giant army. The stocks making new highs, those are your brave officers leading the attack uphill. And the stocks making new lows, well, those are the officers deserting the battle and running away. So the NHNL index basically tells us at any given moment, are more officers charging forward or are more of them running for the hills? As they say in the military, there are no bad soldiers, only bad officers. The direction of that leadership, well, that often predicts exactly what the rest of the army, the broad market, is about to do.
Let's look at a real-world example, the 1989 mini crash. Take a look here at point A on the chart. You see the S&P 500 up top hitting a new peak? Great. Now look right below it at the NHNL index. See how it's also hitting a new peak? That is a textbook sign of a healthy, confirmed uptrend. The officers and the soldiers are marching perfectly in sync. Everything looks fantastic.
But now, watch what happens next. The market pushes to another high, there at point B in September. But look down at the NHNL index. It makes a lower peak. Uh-oh. This is what we call a bearish divergence, and it's our first huge clue that something is seriously wrong under the surface. The army looks like it's advancing, but its officers are secretly falling back. This was a massive sell signal.
And then, at point C, just before the big drop, the market struggles to make one last weak high. But again, look down at the leadership index. The NHNL makes an even lower peak, basically screaming its warning. The indicator then flips negative just one day before that sharp decline, confirming with force that the leaders had completely abandoned the uptrend.
Okay, so we've seen how to track leadership. Now for our second tool. This one goes a step deeper. It doesn't just look at what stocks are doing, but it tries to measure the emotion and the intensity behind those moves. It's time to measure the psychology of the crowd.
And this is the Traders Index, or TRIN. What it does is it compares two different ratios. First, the number of stocks going up versus going down, and second, the volume of those rising stocks versus the volume of the falling ones. So in simple terms, it tells us if the buying or selling is frantic and emotional, or if it's calm and logical.
The source material just nails it with this quote: "The market really is a manic depressive beast." And TRIN? Well, TRIN is our diagnostic tool for spotting these wild mood swings. It helps us see when the market is getting way too manic and euphoric at a top, or way too fearful and depressed at a bottom.
I love this analogy. Think of it like rush hour at a big train station. In the morning, the platform for departing trains is just jammed with people. In the evening, the arrivals platform is totally swamped. TRIN helps us spot these rush hours, these moments of maximum bullish or bearish crowding, which are very often the exact points where the trend is about to slam on the brakes and reverse.
Now, one super important detail here, so listen close. The TRIN chart is usually shown inverted, and it trips people up all the time. So let's just make it crystal clear. A very low TRIN reading, which you'll see at the top of its chart, means extreme bullishness. The market is overbought. A very high TRIN reading at the bottom of its chart signals extreme bearishness or an oversold market. Got it? Low is high, high is low. Okay, let's look at this chart. In October, the S&P 500 pushes up to a higher peak than it made back in September. But now look at TRIN. It made a lower peak. What's that tell us? It means the bullish emotion, that excitement, was actually weaker on that second high. This bearish divergence was another huge sell signal, showing the crowd's conviction was just fizzling out.
And now, check out the flip side. After the market tumbles, it comes back down and retests its lows in November. But this time, TIRIN makes a higher bottom. Remember, on that weird inverted chart, a higher bottom actually means less bearish pressure. This bullish divergence was a sign that the sellers were just exhausted. The selling rush hour was over, giving a really strong buy signal.
So we have our two tools. One tracks the market's leaders, the officers, the other measures the crowd's raw emotion. Now, individually, they're pretty powerful, but when you use them together, oh man, they create a much more complete, high-confidence picture of what's really going on with the market's health.
This brings us to a simple but really powerful framework. Step 1, spot an extreme emotion with TRIN. Is the market totally manic or is it deeply depressed? Step 2, check if the leadership agrees with the price. Is the NH/NL showing a divergence, with the officers pulling away from the trend? When you see both of those clues lining up, you have a very high probability signal that a major reversal is just around the corner.
Now our two main tools, the NHNL and TRIMNI, they give us this incredible window into the market. But, you know, a good detective always looks for corroborating evidence, right? There are other indicators out there that can widen our investigation and paint an even clearer picture for us.
For instance, you've got the advanced decline line. If NHNL tracks the officers, this one tracks the soldiers, the big mass of everyday stocks. So if the officers are advancing but the soldiers aren't following, that's another red flag. Then there's the most active stocks indicator. Think of this as the big money tracker. It shows you where institutions are putting their cash. When these line up with our other signals, our case becomes rock solid.
But, and this is a really big but, here's a critical word of caution straight from the source material. No tool is magic. No indicator works perfectly forever. Markets evolve. Things like options and ETFs have totally changed the internal dynamics over the years. We always have to be critical thinkers and adapt our tools to the market we're in today, not the market from 20 years ago.
At the end of the day, price just tells you what happened. That's it. But indicators like the NHNL and TRIN, they help you understand the story behind the price. They help you ask why. They push you to look past the surface and really analyze the leadership and the emotion that's driving everything. So the question I want to leave you with is this: what secret story is your own portfolio telling you right now?
All right, let's talk about something fascinating. What if I told you that one of the most powerful trading strategies is to figure out what everyone else is doing and then do the complete opposite? Today, we're diving into the world of psychological indicators. We're going to explore why at those huge market turning points, the crowd is almost always wrong. This is going to be fun. So here's our game plan. First, we'll get into the whole madness of crowds idea, why the majority isn't always right. Then, we'll look at how you can actually measure what the herd is thinking. After that, we're going to follow the real money, see what the big players are up to. We'll even listen in on corporate insiders. And finally, we'll pull it all together into a contrarian's toolkit you can actually use. So first things first, why on earth would we even think about betting against what seems like the smart consensus? Well, this first section is all about that. It's the foundation for this whole idea of contrary opinion. This quote from Humphrey B. Neal just nails it. Think about it in a really simple way. For a price to go up, you need more buyers, right? Well, what happens when pretty much everyone who was ever going to buy has already bought? There's no one left to push the price higher. The buying power is completely tapped out. That's when a market is at its most fragile, just waiting for a reason to turn around. And that brings us to the formal name for this whole idea, the contrary opinion theory. Now, this isn't about just being difficult or going against the grain for the sake of it. No way. It's a really disciplined way of hunting for those moments of extreme one-sided agreement, because those are the moments when a trend is totally exhausted, and the risk of a big reversal is through the roof. It's a tool for spotting the big turns, not the little day-to-day wiggles. Okay, so the theory makes a ton of sense, but how in the world do you actually measure what an entire market is thinking? In this next part, we're going to shift from the why to the how. We'll look at the actual tools traders use to get a read on the herd. To really get a pulse on what the crowd is up to, we can zoom in on two groups that are super public and really influential. You've got the professional market advisors, the folks writing all those newsletters, and then you've got the financial media itself. Their collective opinion is often a fantastic stand-in for what the public is feeling. And we can get super specific with this, using services that literally do the counting for us. Check this out. For stocks, you've got Investors Intelligence. They pull around 130 market letters. Now, here's the thing you got to remember. Advisors are almost always optimistic. I mean, their job is to get people excited about investing. So it's really, really hard for them to be bearish. That's exactly why a reading of over 55% bears is such a massive buy signal. It means things are so bad that even the eternal optimists have given up. And on the flip side, when the bears almost disappear, like under 15%, and the bulls are over 65%, a top is probably right around the corner. Same idea for futures with market vein. When bullishness gets down to 20-30%, it's time to look for a bottom. When it's up at 70 to 80%, watch out below. Now let's talk about the media. Financial journalists, they pride themselves on being balanced. Their whole thing is to show both sides of the story, to kind of sit on the fence. So when a trend becomes so powerful, so obvious, that it finally convinces them to jump off that fence and all say the same thing, that is a huge flashing red light. It means the idea has reached everyone, even the people paid to be skeptical. The consensus is complete. And this is just a perfect example of how the media usually operates. I mean, look at this. From the same magazine, on one page, inflation is this big, scary storm, and just a few pages later, it's nothing to worry about. This is their normal state of being. And that's exactly why you have to pay attention when this stops. When you see a major magazine with a giant bull on the cover, or when every headline is saying the same positive thing, that's your signal. That level of agreement is a classic contrarian red flag. And here's another one that's a bit more subtle, but man, is it powerful. Advertising. Just think about the whole process. For some big firm to make an ad about a hot market, that trend has to be old news. They have to see it, make a plan, get the ad copy written and approved, buy the ad space. It takes forever. Now imagine 3 different firms all doing that, and all of their ads land on the same page on the same day. By the time that happens, that trend is ancient. Seeing a bunch of ads for the same hot market is a huge sign that the public is getting the invitation to the party right as it's ending. Okay, so far we've been looking at what people are saying, opinions, right? But opinions are one thing, and where you put your money, that's a whole other story. So it's time to stop listening to the talk and start following the money trail. The government, specifically the CFTC, actually breaks down the futures market into 3 key groups for us. First, you have the commercials. Think of them as the smart money. These are the big corporations, the food producers, the banks, who are in the market to manage their actual business risks. Then you've got large speculators, which are usually big commodity funds that follow trends. And last but not least, the small speculators. That's basically the public, and historically they've earned the nickname the wrong way Corgans because they have this incredible knack for being on the wrong side of the big moves. And here is the absolute key to understanding all this data. In any market, for every long contract, there has to be a short contract. They're always perfectly balanced. But, and this is the important part, the number of people on each side isn't balanced at all. When sentiment gets super extreme, the small group of people on the other side of the trade, by simple math, have to be holding way, way bigger positions per person. This is how we find the big money. Let's just walk through the numbers here, because this is where it gets really eye-opening. Let's say we have 1,000 traders and 12,000 contracts. If sentiment is 50-50, everything's even Steven. But now, look what happens when we hit an 80% bullish consensus. You've got 800 bulls and only 200 bears. To make the contracts balance out, the average bull is only holding 15 contracts, but the average bear? They're short a massive 60 contracts. That's 4 times the position size. That tells you they have much deeper pockets and way more conviction. The big money is betting against the crowd. And it's the exact opposite when consensus is at 20%. And if that table was a bit much, this chart just makes it crystal clear. On the left, with that 80% bullish crowd, just look at the tiny little bar for the average bull versus that huge bar for the average bear. The smart, well-funded money is in that tiny minority. And then on the right, when everyone is panicking and only 20% are bullish, the situation is completely flipped. The few bulls that are left are holding these giant positions, betting on a bottom. So to make all this data easy to use, analysts came up with something called the COT index. All this does is measure how the smart money, those commercials, are positioned compared to where they've been over the last year. It's super simple. When the index gets above 90%, it means the smart money is way more bullish than usual. That's a strong buy signal. And when it drops below 10%, they're extremely bearish, which is a big warning sign to sell. Okay, so we've sized up the crowd and we've followed the big money in the futures market. But now, let's turn to maybe the most direct signal of all, watching what the people who actually run the companies are doing with their own money. You know, corporate insiders, the CEOs, CFOs, big shareholders, they have an amazing track record of buying their own stock when it's low and selling when it's high. Funny how that works, right? And the rule for reading their public filings is actually refreshingly simple. One person buying or selling could mean anything. Maybe they're buying a house. But when you see a cluster of them acting together, like 3 or more insiders all buying within the same month, or 3 or more selling, that's a huge signal. It suggests they all agree that their company's stock is about to make a big move. Now, a quick reality check is important here. Not all of these classic old-school indicators work as well as they used to. The markets have changed. Things like odd-lot ratios, which used to track tiny trades by small investors, aren't as useful because small investors now use mutual funds, and options have become the new playground for speculation. But the core ideas behind the commitment of traders' reports and insider buying, those are as powerful as ever because they're based on the timeless behavior of the most informed players in the game. Okay, we have covered a ton of ground, from psychology to government reports on who's buying what. So for our last section, let's pull all these pieces together into one simple toolkit you can use to look at the market like a true contrarian. Think of this as your go-to contrarian checklist. The next time you see a market that's been running hard for a long time, just run through these questions. Are the advisors at an extreme? Is every media outlet saying the same thing? Are the ads piling up? Where is the smart money positioned in the COT report? And what are the insiders doing with their own cash? Now remember, none of these are for nailing the exact top or bottom to the very day. That's not the point. The point is to be a warning system, to tell you when a trend is getting old and tired and is just about ripe for a big reversal. So, we'll leave you with this one final thought. The next time you see it, the market where every headline is positive, every analyst agrees, and the crowd seems absolutely sure of itself, just stop for a second. Ask yourself, what's the smart money doing? And what's my next move going to be? Thanks for tuning in.
Have you ever stared at a price chart and just had this nagging feeling that you're not seeing the whole picture? Well, today we're going to pull back the curtain on two really powerful indicators that are designed to show you exactly that, the hidden forces driving the market. We're talking about an edge that goes way beyond just looking at price. You see, a standard price chart, it's like a history book. It tells you exactly what happened in the past. But it doesn't really answer the one question you really care about, right? Which is, where is it going next? And that's because it doesn't show you the invisible tug of war, that constant battle for control that's always happening just under the surface.
And that, right there, is the real story. It's not just about numbers on a screen. It's a raw power struggle. You've got the buyers, the bulls, trying to push prices up to the moon. And then you've got the sellers, the bears, doing everything they can to drag them back down to earth. The key to trading isn't about having a crystal ball. It's about figuring out who's winning that fight right now.
All right, so here's our game plan. First, we'll talk about what it means to look beyond that basic price chart. Then, we'll do a deep dive into two amazing tools, the Elder Ray indicator and the Force Index. And finally, we'll tie it all together to see how you can trade with a much deeper level of insight. So, let's jump in.
So, this first part is all about shifting your perspective. I want you to forget about trying to predict the future. A good trader isn't a fortune teller. They're more like a detective. All you need are the right tools to see what's happening in the present, to see who's winning that fight right now, and then you just side with the winner. It's that simple.
So, how do we get this X-ray vision? Well, we start with a tool developed back in 1989 by Dr. Alexander Elder called the Elder Ray. And the name is just perfect. Think about it. A medical X-ray lets a doctor see the skeleton underneath the skin, right? Well, the Elder Ray is designed to do the same thing for the market, to let you see the real power structure, the bones, beneath the skin of the price moves.
Building it is actually a pretty straightforward process. You start with your normal bar chart and you add a 13-day exponential moving average, or EMA. Now just think of this EMA as the market's consensus of fair value over the last 13 days. Then, in two separate windows right below your price chart, you're going to plot two new things, bull power and bear power. This setup gives you this really cool three-tiered view of what's going on.
So here's where the magic happens. Remember that 13-day EMA we talked about, our fair value line? Well, bull power is super simple. It just measures how far the buyers were able to push the price above that line on any given day. And bear power? It's the exact opposite. It measures how far the sellers were able to drag the price below it. It's a pure, clean measurement of each side's strength.
Let's look at some real numbers here for September 19th, just to see how it works. Okay, so the high of the day was 353.5. We just subtract the EMA for that day, which was 351.34, and boom, we get a bull power of positive 2.16. That's it. That's how far the bulls stretch past the average. Bear power works the exact same way, just using the low of the day. It's a really elegant way to put a number on that power struggle.
And here's what it looks like all put together. You've got your price and the EMA up top, right where you're used to seeing it. But then below that, you have this green histogram showing you the bull power, and then at the very bottom, a red one for bear power. Right away, you can see this is so much more than a price chart. It's like a diagnostic tool for the market's internal health.
Now, just watching the levels of bull and bear power go up and down is useful for sure, but the single most powerful signal you can get from the Elder Ray is something called a divergence. This is when the price chart is screaming one thing, like, hey, we're making new highs, but the power indicator underneath is quietly telling you the exact opposite. It's a massive red flag that a trend is secretly running out of gas.
Let's look at a real example from this gold chart because it makes it super clear. See, back in June, the price pushed up and made a new high. On the surface, you think, wow, this is really bullish. But if you look down at the bull power indicator, it actually made a lower high. That's a classic bearish divergence. It's a warning that the bulls are getting tired. And then the exact opposite happened in September. Price hit a new low, but the bears couldn't push their bear power down to a new low. That's a bullish divergence, a huge signal that the sellers are losing their grip.
Okay, so this all boils down to a really clear set of trading rules. And rule number one is non-negotiable. You always trade in the direction of the main trend. And we figure that out just by looking at the slope of our 13-day EMA. If it's pointing up, we are only looking for chances to buy. If it's pointing down, we're only looking to sell. Then, we use these oscillators to time our entry perfectly. So in an uptrend, we actually wait for a little moment of weakness, a small dip where bear power goes negative, and we buy as soon as it starts to turn back up. It's a really disciplined way to buy the dips.
All right, so the elder ray gives us this fantastic X-ray view of the balance of power. But that brings up a really important question. How much force is actually behind the winning side? I mean, is a price move happening with real conviction? Or is it just kind of weak and likely to fizzle out? To measure that, we turn to our second tool, the force index.
This indicator was designed to answer a really fundamental question. What happens when you combine the three most essential pieces of market data? The direction of the price move, the size of that move, and the volume behind it into one single, elegant number.
And the formula is it's beautifully simple. You just take today's trading volume and you multiply it by the change in the closing price from yesterday. So think about it. A big price move on huge volume, that's going to equal a really big force. A tiny little move on low volume, that equals a tiny little force. It's a direct measurement of the market's commitment, or its conviction.
Let's look at this worksheet to see the numbers in action. On November 6th, the market took a pretty big dive, right? It closed down almost 230 points. Now, when you multiply that big drop by the day's volume, which was almost 2,800 contracts, you get this huge negative force index of over 1 million. That number isn't just telling you the market went down, it's telling you there was immense, powerful conviction behind that selling.
Now, the raw day-to-day force index can be a little jumpy, so to filter out that noise and really see the underlying trend in force, we smooth it out with an EMA. And we're going to focus on two versions, a really fast, sensitive 2-day EMA, which is perfect for fine-tuning our entries and exits, and then a slower 13-day EMA, which is like our telescope. It gives us that big picture view of major trends and critical turning points.
Let's look at the 2-day EMA in action. Again, the rule is simple. We trade with the main trend. So when the main trend is up, you actually wait for the 2-day force index to dip below its zero line for a moment. This little dip into what we call the buy zone represents a brief moment of weakness, a pullback, which is exactly the ideal time to get in.
So the rules for this short-term tool are all about helping you sync up with the market's natural rhythm. In an uptrend, you wait for that brief moment when the force turns negative. That's your dip, and you buy. In a downtrend, you wait for a weak little rally where the force turns positive, and that's your signal to sell. And just like with the elder ray, you have to pay really close attention to divergences. A divergence here is a massive warning that the conviction behind a trend is starting to fade.
Okay, now let's zoom out with the 13-day EMA of the force index. This is our big picture tool. Check out what happened in August. The market came down to retest its low, but look at the force index. It made a much higher or shallower low. That's a classic bullish divergence that signals a major bottom is forming. Then in October, the market rallies to a new high, but the force index is tracing out lower peaks. That's a bearish divergence that gives you tons of warning to get ready for a top.
So think of this longer-term force index as the control panel for the whole market. Is it above the zero line? Bulls are in charge. Is it below zero? The bears have control. When it surges to a new high, it's basically giving a stamp of approval, confirming the power behind a rally. And most importantly, a major divergence on this time frame is one of the absolute clearest signals you can get that a primary trend is about to run out of steam.
So we've looked at the elder ray for seeing the balance of power, and the force index for measuring the conviction behind the moves. So how do we put all of this together to get a real, sustainable edge in the market?
It all comes back to this one really powerful idea. These indicators, they're not crystal balls. They're diagnostic tools. They give you a clearer, deeper diagnosis of what's happening right now by showing you weaknesses that are completely invisible on a simple price chart. Just like an X-ray can show a broken bone under skin that looks perfectly fine, these tools can show you when a trend is internally fractured long before it actually collapses.
This new perspective, it just fundamentally changes how you see the market. It's not just about where the price is anymore. It's about the underlying power dynamic and the force of conviction that's driving everything. So the real question is, now that you have the tools to see beneath the surface, what will you look for?
Welcome to The Explainer. Today we're going to break down 3 really powerful systems that pro traders use to navigate the markets. We're going to move way beyond just looking for that one magic indicator and start thinking about complete systematic methods for making those tough trading decisions.
So, have you ever been there? Staring at a chart just totally stuck? You know the feeling. Your favorite trend indicator is pointing straight up, basically yelling buy, but at the exact same time, your oscillator is screaming that the market is way overbought and about to tank. I mean, who do you listen to?
This is like the classic trader's dilemma. Here's the deal. Trend-following indicators, they're your absolute best friend when the market is really moving in one direction.
But the second it starts going sideways into a range, they just chop you up with these frustrating money-losing trades we call whipsaws. And then on the other hand, you've got oscillators. They're amazing for picking tops and bottoms in those sideways markets. But try using one in a strong uptrend and it'll give you these dangerously early sell signals, making you miss out on massive profits.
So, how do the pros solve this puzzle? Well, it's not by just adding another indicator or trying to average out the signals. Nope. They use a system. And that's what we're going to cover. We'll start with the trader's dilemma, then we'll dive into the triple screen system, check out how to ride trends with the parabolic, and finally, look at trading inside the channel.
All right, so first up, the trader's dilemma. Let's really dig into this problem, because it goes way deeper than just two clashing indicators on one chart. The real confusion kicks in when you start looking at different time frames.
And this right here, this is the heart of the problem. You could be looking at a beautiful uptrend on your daily chart, right? Everything looks great. But then you zoom out to the weekly chart and whoa, you're actually in the middle of a huge downtrend. So, what do? Are you a buyer or a seller? It's total confusion. And without a system, it's basically just a coin flip.
Okay, now for our first system, the triple screen. And this brings us to a potential solution. See, the triple screen system was built specifically to solve this exact problem. It forces you to look at the market on 3 different levels, 3 different time frames before you can even think about placing a trade.
The whole idea is built on this really great analogy. Think of the market like the ocean. The really long-term trend, the weekly one, that's the tide. Then you have the medium-term trend on the daily chart. That's the wave. And all the little short-term wiggles, those are just the ripples. Now, here is the most important rule of this whole system, the absolute key. You only trade with the tide, period.
So it's a 3-step process, a 3-screen filter. First, screen 1. You look at the weekly chart to figure out which way the tide is flowing. Second, screen 2. You zoom into the daily chart to find a wave going against that tide. That's your opportunity. And finally, screen 3 isn't another chart, it's your entry technique. It's how you pinpoint the exact moment to jump in as the ripple turns back with the tide. So let's break down that first screen. You start with a weekly chart. Right away, this gives you a much bigger perspective than most folks who are just glued to the daily. On this chart, you use a trend-following indicator, something like the MACD histogram, and the rule is simple. If the slope of that histogram is rising, the tide is coming in. That means you are only allowed to look for chances to buy. If that slope is falling, well, the tide's going out, and you can only look for chances to sell short.
And here's a perfect example of that first screen in action. Take a look at the MACD histogram down at the bottom. See how those bars start getting taller each week? That means the slope is rising. That's your green light. It tells you to only, and I mean only, look for buy setups on your daily chart. Then when the bars start getting shorter and the slope turns down, that's a hard stop. A strict red light. No more buying, now you're only looking for setups to sell short.
Okay, on to screen 2. We figured out the direction of the tide from our weekly chart. Now we switch over to the daily. And here's where it gets kind of cool. We use an oscillator, the exact opposite kind of tool from the first screen. Why? Because now we're looking for a wave that's going against the tide. So if our weekly trend is up, we are actively searching for a dip on the daily chart. That little bit of weakness, that's our buying opportunity.
And check this out. You can see exactly how this filters your trades. Those boxes at the bottom, they're showing us the weekly trend direction we got from screen 1. Now notice, all the buy signals, those little B's, they only happen when the weekly trend is up. And the sell signals, the S's, they only show up when the weekly trend is down. The system just flat out ignores everything else. It won't let you look at a sell signal in a weekly uptrend. It's a fantastic filter.
And that brings us to screen 3. This is all about the entry. So, to recap, we know the direction of the tide, and we found a wave moving against it. Now we just need to catch that ripple the moment it turns back around. And the way we do that is with a trailing stop. So, after you see that daily dip during a big weekly uptrend, you don't just jump in and buy. Instead, you place a buy order just 1 tick above the previous day's high. This is so clever, because it makes sure you only get pulled into the trade if the upward momentum actually kicks back in.
Okay, let's walk through this example. At point A, our oscillator dips. That's our signal. So we place a buy order just above that day's high. But look, the price keeps dropping down to point B. No big deal. Our order wasn't triggered. We just move our buy order down, so it's now just above the high of bar B. Then, finally, on day C, the market rallies, it blows past our entry point, triggers the order, and boom, we're in the trade, timed almost perfectly as the uptrend gets going again. So this table basically sums up the entire logic. It's super simple. If the weekly and daily trends are both pointing up, what do? Nothing. You stand aside, because there's no discount, no pullback to buy. You only get ready to act when they're fighting each other. When that weekly tide is rising, but the daily wave is falling, that's your cue to prepare to go long. It's a complete rule book for when to trade, and maybe more importantly, when to just sit on your hands.
All right, let's switch gears to our second system, riding trends with parabolic. Now this one has a totally different job. The parabolic system isn't about finding trades. It's about what you do after you're in one. It's a tool for managing your stop loss and locking in profits when you catch a really powerful, fast-moving trend.
And it's all built around this one simple but incredibly powerful rule from the legendary J. Wells Wilder Jr. Move your stops only in the direction of the trade and never against it. Basically, if you're in a winning trade, your stop loss only moves one way, in your favor, to lock in more and more profit. You never, ever move it further away to give a losing trade more room. That's a classic mistake.
The cool thing about the parabolic system is that it does this for you automatically. It calculates a new stop-loss point every single day. And here's what makes it so unique. The stop gets tighter not just when the price moves in your favor, but also just as time goes by. Think about that. If your trade just stalls out and goes flat, the parabolic stop will keep creeping closer and closer, eventually taking you out of a trade that's just wasting your time and capital.
But it's not perfect. The system has one major weakness, and this chart shows it perfectly. In those clear boxes, the market is trending hard, and the parabolic does an amazing job just trailing the price up. It's beautiful. But then, look at the hatched boxes. That's a sideways, choppy market. And in there, the system gets you in and out, generating these false signals, those whipsaws again, that can just chew up your account.
Okay, on to our third and final system, trading inside the channel. The whole idea here is to define the market's playing field. You literally draw a channel around the price action to get a clear visual of when the market is getting cheap, when it's getting expensive, and where you might find some high probability spots to enter a trade.
You know, this way of looking at the market really highlights a huge difference in how people think. Amateurs, they love to bet on breakouts. The second the price pokes its head outside that channel, they pile in, hoping they've caught the beginning of the next huge trend. But professionals? A lot of them do the exact opposite. They know that most breakouts actually fail, so they often trade against them. They bet on things getting back to normal, back inside the channel.
Now here's where using channels gets really powerful. You combine them with other tools for confirmation. So on this chart, you've got the channel, and you've also got the MACD histogram. Now look at those two big buy signals. They don't just happen randomly. They happen when two things line up. First, the price is down touching the lower channel line. It's cheap. And second, at the exact same time, the indicator is showing a bullish divergence. That means the downward momentum is running out of steam. When you get both of those together, that's a really powerful signal.
So the big takeaway here should be that there's no one best system. They all do different jobs. The triple screen system, that's your strategic filter. It tells you which direction to trade. The parabolic, that's a tactical tool for managing your risk once you're in a great trend. And channels, they're like a map that helps you see when the market might be overvalued or undervalued.
And that really leaves us with one final thought. Look, success in trading almost never comes from finding that one magic indicator. It just doesn't exist. Real success comes from building a system, combining tools into a logical framework with rules that make sense to you. So the question isn't, what's the best indicator? The real question is, what kind of system could you build that fits the way you see the market?
Welcome to The Explainer. You know, we spend so much time looking at charts and crunching numbers, but today we're going to talk about the real battlefield for traders, the 6 inches between your ears. We're breaking down the psychology that separates the winners from, well, everyone else, all based on some incredible source material on risk. Let's get into it. This quote? It just nails the entire challenge, doesn't it? The single biggest obstacle any trader will ever face isn't the market. It's their own emotions. That adrenaline rush from trading can feel great for an amateur, but it's discipline, not euphoria, that actually leads to consistent profit. So you've got this constant battle raging in the market, right? And it's really between these two mindsets. The amateur is on this wild roller coaster of greed and fear, basically treating the market like a casino, just hoping and praying those losing trades will turn around. But the professional, totally different. They act like a surgeon, completely sober, precise, focused only on perfect execution, and ready to cut a loss without even thinking twice.
Okay, so if we're going to win this battle, first we've got to know the enemy. And here's the kicker. The enemy is us. It's our own mind, all those built-in psychological glitches that make us act irrationally, right when we need to be thinking clearly the most.
I love these analogies because they completely reframe the whole goal of trading. I mean, think about it, right? A pro trader getting mad about a loss. That's like a surgeon fainting at the sight of blood. A pro celebrating a win? That's like a lawyer stopping mid-trial to count their fee. For the real pros, the goal isn't to make money. It's to be the absolute best at their craft. The money, that's just a side effect of doing the job right.
So if it's that simple, why is it so incredibly hard to stay disciplined? I mean, why do so many traders fail? Well, the answer is in these specific psychological traps that we are all, every one of us, hardwired to fall into.
Okay, one of the biggest psychological traps out there is something called the endowment effect. It's this weird little bias we all have. As soon as we own something, it could be a coffee mug or it could be a stock, we start to overvalue it for no other reason than it's ours.
And wow, this quote from psychologist Roy Shapiro, it just explains the danger perfectly. Our trade, it becomes our idea, our creation. It becomes an extension of our own ego, almost like it's our kid. And that attachment makes it unbelievably difficult to cut a loss because it stops feeling like a business decision and starts feeling like admitting you're a failure. All right, time for a little test. Let's see just how rational you are. I'm going to give you a quick scenario straight from the source material. You've got two choices. A is a 75% chance to win $1,000, but a 25% chance you get zero. B is a sure thing, $700, guaranteed. What do you pick? Go ahead, take a second.
So, if you picked B, the sure $700, you're not alone. In fact, 4 out of 5 people make that exact same choice. But, and this is a big but, the other option is actually worth more mathematically speaking. A 75% chance at $1,000 has an expected value of $750. This shows our bias perfectly. We hate risk so much where we're trying to lock in a gain that will take a smaller, sure thing over a probably larger but uncertain one.
Okay, now for part 2. Let's flip this whole thing on its head. This time, you have to choose between two losses. Option A, you lose $700, guaranteed. Option B, you have a 75% chance of losing $1,000 and a 25% chance you lose nothing. Ouch. Which of these terrible choices do you make? And this right here is what perfectly illustrates our biggest, most fatal flaw as traders. It's crazy, right? When we're looking at gains, we're super cautious. But the moment we're faced with a definite loss, we suddenly become these wild gamblers. 3 out of 4 people will take the bigger statistical loss just for that tiny glimmer of hope of avoiding the pain. That is the exact opposite of how a winning trader thinks. So how on earth do we fight against this stuff? I mean, it's literally wired into our brains. Well, it all starts with a huge mental shift in how you even define your goal as a trader.
This right here, this is the professional's mantra. You have to burn this into your brain. A pro's main focus is never, ever on how much money they might make. It is 100% on flawlessly executing their system. They just know that if they do the right things over and over again without emotion, the money just shows up. It's a byproduct.
And that focus on doing things the right way, it's all built on a super clear set of priorities. For a real pro, survival is number 1. Always. No exceptions. You have to stay in the game. Then priority number 2 is to earn a steady rate of return. And only then, way down at the bottom, do you start thinking about big returns. Amateurs get this completely backwards. They go for the home run first, and they end up blowing up their account.
Okay, so once we have that professional mindset locked in, then we can start building a foundation of rules. And these aren't just suggestions. They are non-negotiable mathematical rules for one thing and one thing only: staying alive in the market.
Man, this table shows you the brutal, cold, hard math of trading. It's one thing to see the numbers, but you have to feel what this means. A 10% loss isn't so bad. You only need an 11% gain to get back. But look what happens when you lose 50% of your account. You need a 100% gain. You have to double your money just to break even. The deeper you dig that hole, the exponentially harder it gets to climb out. So how do you avoid digging yourself into one of those impossible holes? Well, pros live and die by one single paramount rule. It is absolutely non-negotiable. You never, ever risk more than 2% of your total account on any one trade. You gotta think of this rule as the concrete floor beneath your feet. It's the maximum damage the market is allowed to inflict on you, period. This is what keeps you in the game long enough to win, even if you hit a nasty losing streak. And honestly, most pros I know think even 2% is way too high. They're risking 1%, maybe 1.5%. That's what survival looks like.
All right, so we have the rule. Now let's talk about putting it into practice during the most stressful, most emotional part of any trade. I'm talking about the exit.
So the pros, they take the emotion out of it. They manage their risk like a machine using a simple 3-stage stop system. First, the second you enter a trade, you place your initial stop loss. That defines your max 2% risk. Done. Second, once the trade moves nicely in your favor, you move that stop up to your entry price. Now your risk is 0. And third, as the trade keeps going your way, you keep trailing that stop up to lock in profits. The key thing here, the stop only ever moves one way, in the direction of the trade.
You know, while a trade is running, maybe the worst thing you can possibly do is start counting those paper profits. Thinking about the new car you're going to buy. The source material calls this a giant red light, a blaring warning sign. It means your emotions are kicking in and they're about to completely hijack your brain.
And that really brings us to the final challenge. And this one's all on you. You can have the best system in the world, the tightest rules, but it all boils down to this single moment.
There's this great story in the source material where the author talks about getting absolutely hammered by the market. He was scared to even place a trade, and his friend Lou gives him this piece of advice. It's just brutally simple and effective. It's like a skier who has a bad fall. They get scared to go down the hill again. The only cure is to get back on the skis and push off.
Because in the end, all the books, all the rules, all the knowledge in the world, it means absolutely nothing if you don't act. Overcoming that fear, that hesitation to click the mouse, that is a pure act of will. And so that leaves you with one final question, a question only you can answer. Can you pull the trigger